In 1972, institutional investors piled into the Nifty 50, a group of blue-chip giants like Xerox, IBM, and Polaroid. These weren't speculative plays. They were seen as unbreakable growth machines, trading at 42 times earnings, while the S&P 500 sat at 19. By December 1972, their valuations hit extremes. Then, in 1973, the oil embargo hit. Inflation spiked, and the Federal Reserve hiked rates to 13%. The Nifty 50 didn't just correct. They plummeted 19% in 1973 and 35% in 1974, dragging the broader market down 48% from peak to trough. Responsible savers who followed the crowd watched their portfolios evaporate, not because they were reckless, but because the system's math had shifted under them. You weren't irrational if you felt that same unease checking your 401k lately, the numbers adding up, but the progress feeling stalled. Or why isn't steady indexing delivering like it used to? I started pulling data from Vanguard filings and S&P reports months ago, comparing concentration levels across decades. What emerged isn't doom, but a hidden threshold where market cap weighting turns from efficient to precarious. If that sounds useful, stay, hit subscribe, and if this helps, give it a like. We're documenting the rise of concentration risk in passive index funds, like Vanguard's VOO, which tracks the S&P 500. As of October 2025, the Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, and Tesla account for 37% of the S&P 500's market cap, up from 30% in 2023. That's $15 trillion concentrated in 7 stocks per FactSet data. For a 45-year-old with $200,000 in a typical retirement portfolio, this means over $74,000 rides on these names alone. It's not about picking winners. It's about how the structure of ETFs amplifies unseen vulnerabilities. You've been contributing responsibly, maxing matches, but if you're benchmarked against net worth medians, say $300,000 for 35 to 44-year-olds per Federal Reserve surveys, the gap feels wider because the index's gains mask underlying distortions. This didn't happen overnight. In 2023, the Magnificent Seven surged 75%, driving 63% of the S&P 500's returns, while the rest lagged. By 2024, they returned 64%, pushing their weight to 33%. Then 2025 brought volatility. An early sell-off dropped the S&P 15% by April, with Nvidia, Apple, and Tesla accounting for 62% of the decline per Virtu's investment data. They rebounded 77% from lows, ending the year up 23%, but the S&P closed at just 16.39%. Vanguard's VOO, holding 504 stocks, now has 8 of its top 10 as Magnificent Seven or close, with Nvidia at 7.95% alone as of September 2025. JP Morgan reports show institutional inflows hit $86 billion into tech ETFs in Q3 2025, echoing the pre-1973 build-up. The timeline reveals a pattern. Low rates post-2022 fueled AI hype, but tariff shocks in late 2024 exposed the fragility. The core mechanism is market cap weighting in funds like VOO. As a stock like Nvidia quadruples to $4.5 trillion by October 2025 per Reuters, it automatically claims more ETF space, 7.95% today, without rebalancing checks. This creates a feedback loop. Gains attract more passive dollars from Vanguard and BlackRock, inflating values further. Incentives align for institutions. They benefit from scale, managing $7 trillion in S&P assets. But for individuals, it's asymmetric. downside hits harder because diversification erodes. Remove the Magnificent 7, and the S&P 500 ex-Mag 7 returned just 59% of the index's gains by September 2025 per Capital Group. What changed? Post-2008 regulations pushed more money into passives, but the math shows concentration crossing 30% thresholds correlates with 20 to 40% higher volatility, as seen in MSCI analyses. Patterns repeat. In the Nifty 50 era, winners were early institutional sellers like Morgan Stanley predecessors, who rotated out by mid-1972, preserving gains. Losers? Retail investors holding through 1974, losing 60% on average per some estimates, because they followed buy and hold amid information lags. The dot-com bubble in 2000 amplified this. Tech hit 33% of S&P weight by June 2000, then crashed 78% for Nasdaq, with top contributors like Cisco dropping 89%. Insiders like venture funds cashed out pre-March 2000, while 50% of dot-com firms failed by 2004. Japan's 1989 bubble saw the Nikkei peak at 38,916, fueled by bank lending quotas. When the Bank of Japan hiked rates, it fell 63% by 1992. Winners? Foreign institutions shorting early. Losers? Domestic savers locked in deflation for decades. Why? Timing and asymmetry. Insiders see filings first. Behind the scenes, its information flows. Vanguard rebalances quarterly, but filings show Magnificent 7 capex hit $200 billion in 2025, per Morgan Stanley, often undisclosed until earnings. This hides overinvestment risks, like in dot-com's fiber optic glut. Institutional behavior shifts quietly. Goldman Sachs noted concentration risks in March 2025 reports, yet inflows continued. The mechanic? Passive funds must buy more of risers, creating artificial demand. $1 billion into VOO buys $370 million of Magnificent 7 automatically. People miss how this distorts benchmarks. Your net worth tracks an index where 7 stocks drive 56% of global returns per nationwide data, leaving the other 493 as ballast. For 30 to 55-year-olds, this threatens retirement timelines. If concentration echoes 1973, a 20% S&P drop, common post-30% thresholds, could shave $40,000 off a $200,000 portfolio, delaying retirement by 2 to 3 years per net worth benchmarks. Status comparisons sting. Peers in equal weight funds like RSP gained 34% since 2023 versus VOO's 68%, but with less risk. The fear is structural. Doing everything right, like consistent contributions, still leaves you exposed because the system's incentives favor the few. Yet, understanding this removes the mystery. It's not personal failure, but math at scale. Clarity comes from seeing the system as it is. Concentration isn't a bug. It's an outcome of passive dominance and growth incentives. It validates why your portfolio feels stagnant despite market highs. The gains aren't broad. This isn't about predicting crashes, but recognizing thresholds where patterns emerge. We've documented how the Magnificent 7's 37% hold on the S&P 500 by late 2025 mirrors past concentrations, driven by market cap mechanics that amplify risks for responsible savers. The patterns show who benefits from timing and why the math changed. I'll keep tracking Vanguard filings and S&P data for shifts. If that's useful, subscribe.